Understanding Price-to-Earnings Ratio in the Share Market. Welcome to today's session on understanding the price-to-earnings ratio, or P/E ratio, in the share market. The P/E ratio is a fundamental metric used by investors to assess the relative value of a company's stock. We will explain what the P/E ratio is, how it is calculated, and what it signifies for investors. It is calculated by dividing the market price per share by the earnings per share. To calculate the P/E ratio, you simply divide the market price per share by the earnings per share. The market price per share is the current price at which the stock is trading in the market, and the earnings per share represents the company's net income divided by the number of outstanding shares. Segment 2. Interpretation of P/E ratio. The P/E ratio provides valuable insights into the market's expectations and investor sentiment towards a particular stock. It is often seen as a measure of how much investors are willing to pay for each dollar of earnings generated by the company. A high P/E ratio suggests that investors have high expectations for the company's future earnings growth. It may indicate that the stock is overvalued or that investors anticipate strong future performance. Conversely, a low P/E ratio may imply that investors have lower expectations or that the stock is undervalued. Segment 3. Different types of P/E ratios. It's important to note that there are two types of P/E ratios: trailing P/E ratio and forward P/E ratio. The trailing P/E ratio is based on the company's historical earnings over the past 12 months. It reflects the market's assessment of the company's past performance. On the other hand, the forward P/E ratio uses analysts' earnings estimates for the future. It provides investors with an insight into the market's expectations for the company's future earnings. Segment 4. Limitations of P/E ratio. While the P/E ratio is a widely used valuation metric, it does have certain limitations that investors should consider. Firstly, the P/E ratio alone cannot provide a complete picture of a company's financial health or future prospects. It is just one of many factors to be considered when making investment decisions. Additionally, the P/E ratio may not be directly comparable across different industries or sectors. Industries with high growth potential or those with different capital structures may have different average P/E ratios. Segment 5. Conclusion and key takeaways. In conclusion, the P/E ratio is a valuable tool for investors to assess the relative value of a company's stock. It helps gauge investor sentiment and expectations for future earnings. However, it's crucial to consider other factors, such as the company's financial health, industry dynamics, and overall market conditions when making investment decisions. That wraps up our session on understanding the P/E ratio in the share market. We hope this information proves helpful in your investment journey. Thank you for joining us today.